Welcome to Insight. I'm Sherian in Seoul. The top stories this hour. Chinese stocks making gains after top leaders signaled bolder economic support next year, including looser monetary policy and a focus on lifting consumption. Investors now await this week's Central Economic Board Conference for further signs of stimulus. We have insight on the economic and market impact as Beijing positions for the second Trump presidency with Fidelity International and LPL Financial. Also ahead, Australia's Reserve Bank makes its rate call this hour, but money markets and economists don't expect a cut until well into next year. And as Islamist rebels move to form a new government in Syria, we'll look at the opportunities and risks ahead with Marcin Ashamari of Boston College. We're seeing big reaction in the markets to Chinese leaders going bigger and bolder with their stimulus plans. Let's dive right in with Avril Hong in Singapore, who has all the details. Avril, it seems investors are liking what they're seeing so far.
They're not aesthetic. I mean, you look at how the CSI 300, for example, climbed 3+% at the start of trade to the highest level in about a month by the most in about a month. It's quite quickly paired those gains. And this is considering that big shift in tone, right? Moderately loose monetary policy. This is actually quite a measured reaction in the markets. And I think this reflects a market that's gone through a number of head fakes from policymakers. Don't forget this Politburo tone will need follow-up from the key economic conference. And we're also waiting out for this looming trade war. So I think while the Politburo signals might help markets find a bottom, what extent we see upside, that's a little less clear. Where we are seeing a lot of gains, though, are in Chinese bonds. And they've climbed by the most since March 2020 on the 10-year. And it's really just extended those gains on these expectations of further easing. Let's flip the board and take a look at what we're seeing in FX as well. I think currency traders' focus is for the potential for the improvement in economic fundamentals, not so much the dovish monetary stance. Indeed, we're seeing dollar China that's pulled away from the 730 levels thereabouts from a week ago. Keeping an eye on the Aussie as well. Yesterday, after the Politburo readout, we saw how it got a boost. Focus now shifting to the RBA decision later this hour, Sherry.
Well, thanks for that. For insight into China's stimulus plans, we're now joined by Stephen Engel and a panel as well. Peiqian Liu is Asia economist at Fidelity International and also CBIZ Investment Advisory CIO, Liu Rathbun. But let me start with you, Stephen, because I wanted to just get into the details of what we heard from the Politburo first.
Sure. We've been waiting for some kind of direction. And again, the Politburo meeting sets the tone. It doesn't necessarily set the specific targets. We could get that after the next couple of days when the Central Economic Work Conference meets in Beijing beginning tomorrow, which essentially sets the agenda for the National People's Congress coming up in March, the annual session of Parliament. But again, the Politburo really did send a very strong message about monetary policy. As you can see on your screen here, we have not seen authorities in Beijing shift to a moderately loose monetary policy since 2011, thereabouts. That's when authorities essentially pushed monetary policy stance to a prudent for the last 14 years, essentially, or nearly 14 years. So this is a significant sentiment shift. But in addition to that, they've also talked about significantly boosting consumer sentiment, trying to boost domestic demand, obviously, at a time when not only is the domestic economy still trying to find its footing. Obviously, the property market hasn't found the floor, and then you have consumer confidence waning still, and then you have this overcapacity, industrial overcapacity, all exacerbated by the one factor of strength, really, in the Chinese economy has been exports. And that is thrown into question now because of the incoming Trump administration has threatened what is essentially could be another trade war with those promises of tariffs of up to 60%. So at least the tone coming out of the Politburo meeting, which is the top 24 senior Chinese government officials, led, of course, by Xi Jinping at the top of the Communist Party there, saying that they are going to move to a more moderately loose monetary policy, and that could essentially lead to a lower borrowing cost, more bond issuances by the government, and essentially boosting consumer sentiment and getting the households to spend money.
Anna, so let me turn to you. Given everything that Steve has talked about, the encouraging signs, but at the same time potential tariffs and all of the different risks, are the markets justified in this reaction?
Well, the markets are kind of muted, right? I mean, they were doing a lot better earlier, but I think there is this euphoria that is coming down. And, you know, from our view, it's rightfully so, because these words or tone are very vague. And we're going to need some details because China needs a lot of help, including money from foreign countries coming in order to prop up the economy. And as much as they want to actually improve consumer sentiment, that's not as easily done. So we're going to have to see the details on implementation. And I think that's why you're seeing some of the muted market action at the moment.
Peiqian, what do you make of the latest announcement from the Politburo, and what else do you need to see for sustained optimism?
I think within the Politburo statement, we have seen the tone change, which, as Stephen has earlier mentioned, this signals a more concerted effort to resolve some of the structural issues domestically. So I see two significance within this Politburo meeting. Firstly, we see a pivoting into more and greater support into domestic demand, which is exactly what the economy needs right now. And secondly, opening up the possibility of more unconventional monetary policies, and including the change in monetary policy stance to pave way for more reactions in what's going to be happening next year.
And we are getting the breaking trade data at the moment. So here for our viewers, exports year-on-year growth for the month of November of 6.7%, which is below what economists had expected. It's also a significant slowdown from the previous month. The imports year-on-year is a contraction of 3.9%. The expectation was actually for upside, even slightly in the imports year-on-year growth. Now this brings the trade surplus to $97.4 billion. So again, I think the key figure here being how much the export number has really slowed down in the month of November. We're talking about year-on-year growth of only 6.7%. Peiqian, give us your reaction to these latest data sets.
I think looking at today's exports and imports number, which gives us affirmation of the gradual slowdown of what has been happening externally. So a slowing external demand is what in our base case next year. Exports is no longer going to be a main engine of growth going forward, and there is a need to pivot into domestic demand to support growth. Having said that, I think with the lingering tariff risks going to happen next year, we might still see some impact or disruptions to the momentum of exports, depending on when and how the tariffs are going to be playing out.
And Steve, of course, we continue to see this tit-for-tat between Beijing and Washington.
Yeah, and I think that's going to probably increase. I think Beijing is trying to figure out what levers it can pull in retaliation. They won't necessarily say it's retaliation. They made a move last week, and they tied it to U.S. congressional visits to Taiwan and the arms sales from Washington to Taiwan. But clearly, some of these moves are around, the retaliation for not only the threats coming from the incoming Trump administration, but but further tightening of those export controls from the Biden administration. So China is looking, whether it's in rare earths or in drone components or any other aspect where it can find areas of leverage, it will use that. And again, on this stimulus, I agree with Anna about needing concrete stimulus measures, because there's been a bit of promise fatigue from authorities after those September stimulus measures. And leading up to December, we went through the third plenum. Not a lot of momentum was gained there because there was no detail, no meat on the bones. And again, the Politburo set the tone, did not have a lot of meat on the bones, even though they covered a whole list of issues that are afflicting the Chinese economy right now. Now we turn to the Central Economic Work Conference. We might get details, but we might have to also wait until March and the National People's Congress when everything is stamped into law. And that might be a strategy, keep in mind, because they are learning their lesson about not communicating well to the markets, because the markets react pretty swiftly and harshly when there's not explanation. We saw that in August of 2015 when there was currency trouble and the markets were not getting communication from Beijing, and there was turmoil in the market. So I think they're trying to communicate that they have the tools in place to intervene, but they're waiting to see how these tariffs issue really plays out in the opening days of the Trump administration.
Anna, so where do Chinese assets go into 2025?
Well, you know, we remain a bit skeptical of all the things that Steve said. I mean, we agree. We need to be able to see the details and to see how this stimulus hits the economy and, frankly, where it hits the economy. So we stay underweight. We are currently underweight. We have been underweight Chinese assets, and we're going to remain underweight. This pop that we're seeing today, it's quite nice. We're going to take the gains. And we're going to consider it value trap until we see otherwise. But frankly, timing, and I agree with Steve. I mean, there has been a lesson learned. This market can go up very quickly, but it can also go down very quickly, and we don't want to be caught catching the downshift.
Peiqian, we actually seeing Chinese real estate shares rising, not surprising given what we heard from the Politburo when it comes to really supporting the property markets. Are you seeing any change in that sector that could be meaningful in 2025?
Well, I think from the tone change, we have seen stronger language or determination to stabilize the property sector. But if we look at the fundamentals of the China property sector, we still see quite a bit of challenge in terms of inventories and demand. So I think it's still a long way to stabilize the Chinese property sector. We do expect some momentum of policy easing coming through continuously in 2025 to support the sector, and that is hopefully to bring or establish a stronger, firmer bottom line to the sector going forward.
And then where does that put Chinese assets in relative to other more perhaps appealing markets around the world?
Well, from a valuation point, it's hard to find more appealing markets around the world, especially in the U.S., where the forward PE ratio is above 22x, 22 multiple. But at the same time, we've here in the U.S. have talked about the U.S. resilience and U.S. exceptionalism, and I do think that the multiple is reflecting a premium on not only the exceptionalism, but if you think about what is happening around the world, some of that safety premium in U.S. assets. So compared to that, you know, China, not only is there stimulus being announced today, but they've really never actually gotten tight on their policy. They've been easy. So that is a sign, this moderately loose policy is sort of a sign in a different way that it is very weak, that the Chinese economy is weak and the Chinese markets are weak. And so we don't really feel the reason to go into Chinese markets with enthusiasm in 2025, sort of counting on a stimulus from the government.
Yeah, and especially at a time when we have the Trump 2.0 administration coming in, right? Steve, we also heard that President-elect Trump actually said that he had an exchange with Xi Jinping. What sort of policies can we expect from both sides going into 2025 as Trump takes office in January?
Well, I'm sure they had a lot of questions for each other. I hope they did, actually, because, look, they know each other as far as the first term, 4 years, and it was quite contentious, even though Donald Trump refers to Xi Jinping as his good friend. There were some very contentious issues. Yes, they negotiated a first phase of a trade agreement, but that was quickly scuppered because of the spy balloon incident over the United States, and then, of course, COVID pretty much locked down China for more than 3 years. So whether they can build on any kind of common ground that they were sort of able to achieve in that first round of a trade deal, that's the big wild card, whether those threats of 60% trade tariffs can be negotiated down, as many people expect. But keep in mind, if you look at all the picks that Donald Trump is putting into his cabinet, it's full of China hawks. And that does not necessarily bode well for getting off on the right foot with Beijing.
Bloomberg Stephen Engel there. Thank you so much for joining the panel. We have more with CBIZ Investment Advisory Services CIO Liu Rathbun and also Peiqian Liu of Fidelity. Coming up, we also are going to talk about the UK warning the turmoil in Syria could spark a fresh migration crisis across Europe. We'll get insights from Boston College Assistant Professor Marcin Ashimari. Much more ahead. This is Bloomberg. South Korean stocks are seeing their first daily advance since last week's short-lived martial law declaration thrust the country into political turmoil. The won also edging higher against the dollar. The aggregate market value of companies included in the two benchmarks had declined by $100 billion in 4 sessions through Monday. The rebound comes as authorities repeat promises to stabilize sentiment, describing earlier market moves as excessive when considering Korea's economic fundamentals. Investors have been grappling with uncertainties as the opposition continues to push for President Yoon Suk-yeol to go after he narrowly survived an impeachment vote over the weekend. Peiqian Liu, Asia economist at Fidelity International, and CBIZ Investment Advisory CIO Liu Rathbun are still with us. Thank you guys for staying around. So let me start with you, Anna, because I want to get your reaction to what the Korean markets are doing. It's very surprising because I really have not seen any hint of resolution to this political impasse.
Yeah, I mean, this was very surprising. Martial law is not something you see every day. And certainly photos and images of military mobilization in a developed country is not something you see every day either. So the market reaction, it's in a way not surprising from the fact that it was so new. But at the same time, the fundamentals of those companies that are traded in those exchanges, they haven't changed. And frankly, I think we're going to need to see a resolution, which will probably mean a different leader emerging, because I think there's a big stain on the current president. Once that happens, I think you're going to see some calm coming back into the markets.
Especially if we do see South Korea's opposition forcing through that budget sort of as a power play. I mean, that was one of the key issues why President Yoon Suk-yeol actually decided to declare martial law, is one of the guesses at this point of how we saw this political instability being sparked here in South Korea. But Peiqian, how much would the budget actually help 2025, the state of things here?
Well, I think Anna has been putting it quite well. It's not usual for us to see such incidents in Korea in terms of the political scene. So that is causing quite a bit of volatility within the domestic markets. But if we look at how Korea has been facing certain challenges, and they are not all coming from domestic, what I would like to highlight is that Korea is facing quite a bit of headwinds from external economies next year, both in terms of the slowing down in global manufacturing cycle, as well as perhaps potentially tariffs risks rising. So with all that set of external challenges, we do put higher hopes on Korea's budget to be more supportive of the domestic economy. So yes, uncertainties in the near term, but ultimately I think both fiscal and monetary policies need to take the heavy lifting in terms of supporting the domestic demand next year.
Peiqian, the thing is that we have seen this sort of political instability in the past in South Korea, but it seems that the economic background was different, whether it was a case of President Park Geun-hye, who was impeached in 2016. Tell us a little bit more about the economic fundamentals in this country. As you mentioned, the external picture doesn't look that great.
Exactly. I think with all the external challenges we're facing, in 2025, we think that Korea's growth is just going to slow and slightly below potential, below 2%. So with that as a backdrop, we have a higher expectations for Bank of Korea to continue with its rate cuts in next year. So we're looking out for another 2 or 3 rate cuts from the Bank of Korea to support the domestic economy in terms of consumption and the household sector.
Anna, does that also make a difference in what sectors you like here in the South Korea market?
Certainly tech. I think there's a little bit of immunity in tech, and that is because tech has sort of become globally not only national security and something that you absolutely need, but from a day-to-day life perspective, also sort of a utility. It's like the new utility. So I think in terms of sectors, I think tech, especially in the chips category, South Korea is one of the leaders. And I think that is a safe bet. I think I agree with the slowing down of the economy and slowing down of the domestic demand. And I think that is something that we have to watch for. So anything that is a domestic facing and especially retail, I think those things are going to face some headwinds in 2025. And that really is a global story, not just a South Korea story.
Anna, what do you like across Asia then? Because we have so many big tech players around.
Yeah, so from Asia, certainly TSMC, we have exposure to Samsung. We have exposure to. We do like tech across Asia, and we do think that tech is going to play an important part, especially with the geopolitical, some of the geopolitical uncertainties out there, and it's going to be anchored. But in general, sort of tying with the conversation about China, we are in general underweight Asian markets. Because so much of the trade is done with China. So if we're a little bit, not bearish, but a little bit down on China in terms of investing, we have to take that into consideration for all of the neighboring countries. So unfortunately, that gives us an underweight view of Asian markets, especially when compared to U.S. markets.
Liu Rathbun, good to have you with us, CBIZ Investment Advisory CIO. And Peiqian Liu of Fidelity International is actually sticking around. We do have a little bit of news right now crossing the Bloomberg at the moment. We're hearing that New York prosecutors have filed murder charges against a suspect in the killing of the UnitedHealth CEO. This is according to the AP. That would be Luigi Mangione, 26, who was arrested for the murder of the insurance executive in Midtown Manhattan. Of course, we had days of a manhunt on this. Right now, we've heard from the AP that the New York prosecutors will be filing murder charges. Coming up on Insight, we're counting down to the RBA decision, with economists expecting a 9th consecutive hold, despite slowing growth and waning business sentiment. This is Bloomberg. We have Australia's central bank rate decision, with economists expecting the cash rate to remain at 4.35%. Bloomberg Economics also thinks the case to pivot to easing is not strong enough yet. This despite inflation falling into the 2 to 3% target band. A string of surprisingly strong labor market readings may provide the central bank cover to keep rates higher for longer. Right now, coming out, the RBA leaving the cash rate as expected, the target at 4.35%. They're saying that underlying inflation remains too high, that the board is resolute in determination to return CPI to target. Their growth in output has been weak. Now, remember, we did get those GDP numbers for the previous quarter coming in much weaker than economists had expected, which is why some people were thinking that perhaps the RBA may be leaning dovish. So that's sort of the language that we'll be watching out for right now. The RBA saying that labor market conditions, though, remain tight, that the board will continue to rely on data and risk assessment, that they're gaining some confidence that inflation pressures are declining, but the RBA still leaving the cash rate target at 4.35%. As expected, that underlying inflation remains too high, and the board is resolute in its determination to return CPI to its target. So let's get a closer look at the market reaction with Avril Hong. Avril, I mean, we had seen the Aussie dollar declining ahead of the RBA decision, given expectations of a dovish lean. What are you seeing right now?
Absolutely. I think it's so interesting, right? I mean, I think that growth miss recently is really what spurred the dovish guidance speculation from traders. And as you say, the Aussie was on the back foot. Despite yesterday, we saw a bit of a boost after the Politburo readout. Of course, this is a currency that's seen as a proxy to China of sorts. We are keeping an eye on the guidance. Anything short of dovish, I think you're going to see a reaction across assets. And indeed, it's this idea that the central bank is unlikely to move until May. That's the consensus, at least. Given how it was cautious to tighten, on the other end, it might be cautious to ease as well. And I think you're seeing a bit of a digestion in terms of the extension of declines on the Aussie dollar, which is interesting. Bonds have already had a pretty good run, so it looks like a bit of a dovish read-through just based on what we're seeing on the 2 and the 10-year. The stocks are also pairing some of the earlier declines, Sherry.
Yeah, because take a look at what the RBA is saying right now, because they're gaining confidence of CPI returning sustainably to target. And I think one of the most important lines that's come out is the fact that the Reserve Bank of Australia is now seeing some upside risks to inflation that they have appeared to ease. And remember, as we continue to see economic growth slightly taking a hit in Australia, and they're now acknowledging that eco data has been softer than what was expected back in November. So many economists and traders had expected the RBA to hold in this meeting, but still lean dovish given the pressures on the economy. And it seems some of what they're saying right now, the commentary points to that. The RBA saying that output growth has actually been weak. We, of course, follow all central banks across Asia. One that we're watching very closely is the RBI. Avril, Indian assets in focus that we might see. We are actually going to see a new governor instated at the RBI.
Yeah, I mean, this ends the weeks of speculation, right? Similar to what we saw in Australia, India also had a big growth miss recently. So that's really what spurred this heated debate about whether the 6-year term of the current governor of the RBI, Shaktikanta Das, would indeed be extended, or who his potential successor might be. Remember, this is a governor who has been under immense pressure to cut, no least from the finance as well as the trade ministers. And so now we're getting a new central bank governor. The trader speculation, I think, is that he might have a bit of a mandate to get on with it, start cutting. So the expectation is for a move in February. Bloomberg Intelligence actually going a bit against the grain here, seeing more than a quarter-point cut. It actually thinks we might see 50 basis points of easing. And certainly if you look across assets, I think bond traders were already getting quite excited given the liquidity tweak that we saw from the RBI last week. Maybe further expectations of easing, a bit spurring things along. When you look at the 10-year, for example, a bit of weakness coming through, I think perhaps on the slight dovish expectations on the Indian rupee as well. Sherry.
Avril Hong there with the latest on the markets. And of course, we're watching India, we're watching Australia. Let's bring back Peiqian Liu, Asia economist at Fidelity International. She believes the RBI may see some gradual monetary policy easing as inflation slows. Peiqian, thank you so much for hanging around. Of course, we're following the latest lines from the RBA as well. And as expected, they seem to be a little bit more cautious about economic conditions. The conditions have weighed on household discretionary spending as well. Is it going to be another year of sort of diverging monetary policies around the world, or are we going to see now a continued trend towards the easing narrative across Asia?
Thanks, Sherry, for the question. Yes, indeed, macro divergence is one of our key themes for 2025. In terms of global central banks, we are likely to see desynchronized move. To the point on RBI, I think we generally agree with the market assessment that easing is indeed needed because we have already seen signs of slowing down in India's capex manufacturing sector. And also, the RBI has been keeping rate on hold for this particular meeting on signs of some reacceleration of inflation recovery. But broadly, I think inflation is going to ease next year, and which supports the rhetoric of a gradual easing from RBI next year.
Yeah, we continue to hear from the Reserve Bank of Australia as well. They're pointing to geopolitical uncertainties remain pronounced. I guess this is an issue for all central banks around the world, isn't it? I mean, we talk about inflation and reining in prices, but what sort of impact could geopolitical tensions around the world have on price pressures?
I think rising geopolitical uncertainties and is certainly going to inject a lot more volatility in the global markets. And also, in terms of looking at global central bank pathways, inflation has also been playing different roles in different economies. For example, what we worry most about is inflation stickiness within the developed markets. And with rising tariff headwinds, that certainly is going to introduce a lot more uncertainty to the dynamics going forward.
How much uncertainty for the United States? Because it seems that we're headed towards another year of 2025 U.S. exceptionalism when it comes to how resilient that economy has been and what that would mean for other Asian economies. Because if you have a resurgent dollar, that's also going to have an impact or more pressure on the Asian currencies.
Yes, in our view, I think a stronger dollar is going to putting some pressures on Asian central banks, especially when central banks here in the region are facing certain slowing down in terms of domestic demand and also headwinds from trade sectors. So overall, I think that's just going to bring a lot more shallower rate cuts generally within Asian central banks, with the exception of Japan, of course, which is firmly on a path of reflation. But for the rest of Asia, gradual and shallower rate cuts are our base case expectations for 2025.
For Japan, do you expect a rate hike come next week, or are we further out into 2025?
I think for Japan, the next two meetings are pretty live in a way that Japan's data streaming in right now has been very supportive of the positive momentum of wage inflation dynamics, which means that the condition is ripe for the BOJ to conduct another rate hike. In terms of timing, it's both likely to be in December or January, depending on the interaction of FX and market volatilities. But I think from a fundamental perspective, looking into the medium term next year, we are looking for Bank of Japan to hike its rate gradually into a nominal policy rate of around 1% by the end of 2025.
Peiqian Liu of Fidelity International, it was really good to get your insights today. Thank you so much. Of course, we'll be watching the BOJ decision next week. As right now, we're also watching the Reserve Bank of Australia's decision to hold the key rate steady, but we're seeing that downside pressure now on the Aussie dollar as the RBA says that the CPI target, it's returning to target. That is, of course, a key message here out of the RBA because they're finally gaining some confidence that CPI is returning to the levels that they want to see, that they're seeing some upside risks to inflation, that they appear to have eased now. Of course, they're also talking about how household spending has been a little bit weaker and that output growth has been weak as well, sort of acknowledging the pressures on the economy. We had expected the RBA to hold rates steady today, but perhaps lean a little bit more dovish given the pressures on the economy that we saw in their latest GDP reading that was much weaker than economists had expected. Right now, the Aussie trading at that 63.90 US cents level. Take a look at how cryptocurrencies are trading because we've seen a lot of volatility in the crypto space as well, especially after we saw that President-elect Trump-fueled rally starting to fray a little bit. Still, U.S. Bitcoin ETF inflows are now nearing $10 billion since Trump was actually elected. Binance Holdings CEO Richard Teng believes that the future is bright for crypto. He spoke to us about his expectations for the market ahead of the return of Trump.
If you tell people before 2024 Bitcoin will hit 100,000, there'll be ETF being approved for Bitcoin, Ethereum, Solana, and several others. And as well as institutions, I mean, the largest asset manager in the world, BlackRock, has gone from a skeptic to believer. I think people will not believe it. But come to the end of 2024, all those have come true. We have now a very crypto-friendly president in the States and extremely smart strategy appointing an AI and crypto czar on that front, because this too represents the most innovative technology for the future, and countries will do extremely well. I mean, Abu Dhabi this week, the capital of capital, again, Abu Dhabi and UAE has been very foresightful in that front to start investing AI, blockchain, to move those very early on. So we are seeing the results of all those deployment in Abu Dhabi and UAE now. So countries will do very, very, very well to continue to focus on these two technology. And we will continue to focus on serving our fast expanding user base. We're close to 250 million users globally now, 70 million onboarded this year alone. So we are very excited with the journey ahead.
But of course, Binance is under monitorship by the US DOJ and the US Treasury's Financial Crimes Enforcement Network. Would you be looking to press the Trump administration to shorten or terminate the monitorships, given the president-elect's kind of preference, as we say, for looser crypto regulation?
Well, I mean, any of those discussion, I think, is new. I believe that compliance is the way to go, right? So Binance has always been a user-first organization. But going forward, given that regulations is going to be much clearer throughout the world, we have the ability to invest very heavily in compliance space. I want to make compliance a competitive advantage for ourselves, right? So last year alone, we invested $213 million just on our compliance program, which is a more than 30% increase compared to the year before. And this year, it go up even more. We are the most licensed and regulated exchange globally now. We have more than 20 different jurisdictions that license and regulate us. More recently in places, exciting places like India and Argentina. So we are working with global policymakers, lawmakers, to really support the crypto journey, to support the crypto deployment. And we continue to work very closely with US monitors on that front to continue to see whether there are areas that we can enhance the program further. I think is a good competitive advantage. We are able to invest in places that our competitors are not being able to invest.
Binance Holdings CEO Richard Teng speaking with Bloomberg's Lizzie Burden. Coming up next, Boston College Assistant Professor Marcin Ashamari joins us for analysis of the political turmoil in Syria. That's as the UK says it could lead to a new migration crisis across Europe. This is Bloomberg.
The humanitarian situation in Syria is dire, with almost 17 million people in need. Millions are refugees, largely still in neighbouring Turkey, Lebanon and Jordan. Seeing so many start to return to Syria is a positive sign for their hopes for a better future now that Assad is gone. But a lot depends on what happens now. This flow into Syria could quickly become a flow back out and potentially increase the numbers using dangerous illegal migration routes to continental Europe and the United Kingdom.
UK Foreign Secretary David Lammy warning of a fresh migration crisis across Europe sparked by the turmoil in Syria. Meanwhile, the rebel group that toppled the al-Assad regime is forming what he calls a temporary government. Mohammed al-Bashir, who is the head of a quasi-government set up by HTS in 2017, is said to be overseeing the transition. Joining us now is Marcin Ashamari, assistant professor at Boston College. Marcin, great to have you with us. What can we expect from this transition government, and how high is the risk of Syria becoming a failed state like Libya, for example?
Thank you for the invitation. So Syria right now is at a very critical point, but it's important to recognize that it's really too early to say anything definitive about its future. We've seen in other cases the initial moments of jubilation, of recovery, of people rushing to prisons to find family members. This is, a moment of anarchy, a moment of recovery, and it will take weeks, if not months, to see where Syria is heading. There are some positive signals as well as negative ones emanating from the country. Right now, we've seen that it was a peaceful transition of power between the armed group, the HTS, that had reached Damascus, and they hand over by the remnants of the government after the president had fled. We also saw the next morning the prime minister of Syria being led out to a meeting with the leader of the rebel group, and then following that shortly, you have a transitional government which will be tasked with really trying to keep things as normal as possible for everyday people and critically protecting state institutions, so things like banks, like ministries, just the everyday the institutions of everyday life.
Does that mean that perhaps what we've heard from Secretary Lammy of this return of Syrians into Syria can actually stay? What are the risks of another migration crisis in Europe? We're already seeing Turkey housing so many Syrian refugees.
I mean, it's a little bit disheartening to see that Europe's initial reaction is what's going to happen about migration. I think what we're seeing at the border of Lebanon, at the border of Turkey, the thousands of Syrians lining up to go back home to see their family members really, really attest to the fact that people don't want to be refugees and they don't want to leave their homes, and that with the appropriate circumstances, they are eager to be back home and to, try to resume a normal life that they've been robbed of for decades now. I don't think that should be the top priority of trying to figure out what migration crises might be, but rather trying to put all energy towards making sure that the transition in Syria creates an environment that's stable enough for people who clearly do want to go back to their country to be able to, while also critically not rushing people to return to a country that is currently in a state of anarchy.
Sure, but it's understandable when you're considering that huge numbers of migrants can cause political and economic pressure on neighboring countries. And so is the perhaps implications for other powers in the region? What can we tell from the fall of the Syrian government about what's happening in Iran and also in Russia?
Really interesting regional implications. So what really happened in Syria right now could have only been possible because of the realignment of power in the region right now. Essentially, Israel had made Hezbollah, which is Iran's strongest ally, incapable of really protecting or propping up the Assad regime. And Iran had very quickly distanced itself from Assad's regime. Russia, also completely overwhelmed by Ukraine, found little interest in continuing to protect Assad. And this retreat of his key allies has created an environment in which the key international actors in Syria, Turkey, the United States, and some of the Arab Gulf countries were able to, have a stronger position in the regional balance of power, which allowed the Syrian rebels to advance further and to depose the regime of Assad. What this means going forward for Iran is that it's genuinely has lost its big battle against Israel, at least, and the United States by extension, maybe for now, maybe for the long run, but its key ally in Lebanon has been crippled. Syria, which used to be an important route for it, has also changed hands entirely. And you can see the rhetoric emanating from Iran now being essentially they're backtracking. They're saying things like, we abandoned Assad because he was not a useful ally to us. But clearly this is a big setback for Iran.
Let's talk a little bit about Israel. You mentioned Israel there. What do they come out with after this chaos in Syria subsides?
Israel wasted absolutely no time in invading Syria. So the Golan Heights, which was illegally occupied by Israel after the 1967 war, Israel advanced further into Syrian territory. They've also been attacking the remnants of Assad's military assets in Syria to prevent, in their words, them from falling into rebel hands. So it's been a very dangerous situation on that front. Israel didn't have a preference for removing Assad or keeping him. They seem to have been willing to have him stay. He didn't really represent as strong a supporter to Iran in this particular era during the Gaza war and during the Lebanon war that he had been in the past. So he was, Israel benefited from the situation in this sense that they were able to invade Syria, essentially, but they weren't necessarily, in favor of it going one way or another. It was just a very quick reaction from what their perspective is, an opportunity to take more territory.
Marcin Al-Shamari, Assistant Professor of Political Science at Boston College. Great to have you with us. Thank you. And take a look at how Asian benchmarks are trading at the moment. The Nikkei looking like this after coming back from their lunch break. Right now, we are seeing some gains of 0.4%. And this, as we're seeing the Japanese yen also holding steady. Of course, while we'll be watching our Chinese assets, given those big gains that we saw on that Politburo promise of more support, we'll be watching the economic conference as well. And this, of course, as Hong Kong goes on a lunch break. Here's a look at our guests for tomorrow. We have LGT Private Banking, Stefan Hofer, and others. This is Bloomberg.